Hello traders, welcome back to the channel. Igor here, MrTopTick.com. If this is your first time joining us, please subscribe to the channel, leave a like, and share this video with someone you think could benefit from it. Please note that the content you're about to consume is strictly for education and or entertainment purposes only. This is not a financial advice. If you are looking for one, please contact your financial advisor. Today, I want to talk about a trade that's become very popular amongst various different trading communities. Some call it a 1-1-2, some call it a 1-1-3. This trade could be built out many different ways. I refer to this trade as a bear trap. As you will see in this video, the goal of this trade is to capture price in a trap. The trade itself is neutral in nature, slightly bearish. Our goal is to capture price inside of the trap that we're going to build out by placing an out-of-the-money put-debit spread, and we're going to finance the purchase of the put-debit spread by selling several far out-of-the-money naked puts. Please be aware that selling naked options has a ton of risk. If you aren't familiar with selling options naked and the kind of risk is involved, you can consider doing similar trade, which is risk defined. Instead of selling a far out of the money naked puts, you could also sell an out of the money put credit spreads. I've made a similar trade using put credit spreads instead of selling naked options, and I'm gonna link this video here. So let's talk about basic structure of this trade. This trade is referred to as 1-1-2 for the simple reason is because we have one long option, one short option, and two short options. So this is a 1-1-2. I bought to open a 40-point wide put debit spread. I bought 3,800 37.60 put debit spread. I paid $8.55. To finance the cost of this debit spread, I went and I sold two of the 3250s for $5.70. I had collected $11,400 for selling the 3250 puts, and I paid $8,550 for the long put debit spread. I had collected $2,850 to enter this trade, which means that if the S&P stays above 3,800, which is my long put of my put debit spread, if the S&P remains above 3,800, I will get to keep the $2,850. But if the S&P starts to go into the trap, which is between my long put debit spread and my short out of the money put, that is where we make the bonus. If the S&P is inside of the trap, which is between 37.60 down to about 32.50, at expiration, the long put debit spread is worth its full potential value, which is 40 points. The out of the money naked put is going to expire worthless. This trade has a potential of making $4,000 per one spread plus whatever credit we received up front. Now I'm going to step through this trade. There were not a lot of adjustments made along the way, but I will show you everything I did in this trade, and hopefully it will be clear what my thought process was as I was making incremental adjustments. When I say incremental adjustments, because I traded a 10 lot, it made this trade a little bit more flexible, because if I just did 1-1-2 instead of 10-10-20, I wouldn't be able to scale in or out of this trade. I would have to be all in or all out. So trading with a little bigger size gives me the flexibility to make incremental adjustments if needed as the trade continues to develop. Now, I do realize that trading a 10 lot on the SPX, which is the big S&P contract, is not for everyone. I do know that Tom King likes to use ES options. So he trades options on futures. Options and futures use span margin, which is very friendly. However, whether you use span margin or portfolio margin, you do have to keep in mind that if the underlying asset starts to move against you, in this case, if the market starts to pull back quite aggressively, whether it's span or portfolio margin, buying power will be used up. And if you don't have any dry powder, you could potentially get squeezed out of the trade with a margin call. So that needs to be something addressed and planned for before you take the trade. This trade was a 10 lot, and in the portfolio margin account, buying power requirement for this trade was somewhere between $180,000 and $200,000. So as we step through this trade, we can go forward first couple of days to see how and what was happening. So we can go to, let's say we go 1 week forward. S&P is now trading down about a 0.4 standard deviations from where we started. Volatility has risen just a tiny bit. This position is showing a slight gain, and this is probably due to mostly decay of the out of the money short puts. We'll go forward 1 more week. As we can see, nothing much is happening. We're still down about a 1/2 standard deviation, so we're well within the expected range that was established at the time when we took the trade. S&P is currently trading at 38.91. We have 14 days that has gone by since we took the trade. We are now still outside of the trap. This trade is showing a profit of about $7,132, and we can go and take a look and try to understand where this profit is coming from. So my guess is that most of the profit was from the decay of out of the money puts. We can see that these puts are now trading for about $3.60, and I initially sold these puts for $5.70. So we have about $2 worth of decay on the out of the money short puts times 20 contracts. So that's about $4,000 gain from the short puts, and the other $3,000 came from the put debit spread that is now gaining in value. It's increasing in price as the underlying asset is starting to move closer towards the long put debit spread. Now we can go forward. Let's go 1 more week. We are now inside of the trap, which is what we want to see. 21 days has gone by. SPX has moved just over 1 standard deviation from the time when we took the trade. Volatility has increased about 30%. This trade is showing a profit of about $12,000. And again, now we can go back and take a look at where this profit is coming from. So my short out of the money puts that I sold for $5.70 are now worth $6.70. So I am taking a loss, an unrealized loss in the short out of the money puts. However, my long put debit spread is now in the money, and I initially paid $8.55 for the put debit spread. We can see what this put spread is trading for right now. This put debit spread is now worth $22.70. So that is where most of the gain is coming from. Now, this is the perfect case scenario for a trade like this. We want price to be somewhere inside of our long put spread and our short out of the money naked put. However, we have 16 days left until expiration. There's still a lot of time left, and the price could move drastically against us, or it could move higher and potentially out of the bear trap. So we need to start to think about what we're going to do in the event of more downside or more upside. I like to look at my net Greeks to kind of dictate and tell me exactly what I should expect on any given day, or how much do I want to hold as far as directional exposure. Right now, this trade is, you can call this flat on a 10 lot. If you're positive 26 S&P delta, that's pretty flat. Let's go forward another day. This is Thursday, September 29th, right? We have this down day, we're down about 104 points on the S&P. We're down about 2 standard deviations, and we are down about 1.63 standard deviations from the time we took this trade. Now we can see that, just one day before, this trade was showing a gain of about $12,132. We have a big down day, and this trade is now up $9,932. So there's about a $3,000 difference. Even though we do have a long put spread, which is gaining value, now the price moving towards our out of the money naked put, that's starting to put pressure on this trade. And now, as we continue to head lower, I'm also starting to accumulate positive delta in this trade, at which point I need to decide how much delta I want to continue to hold. If I'm not comfortable with that delta, I could potentially make an incremental adjustment to reduce my net delta. Positive delta could be reduced by buying out of the money or at the money puts, depending on how much delta I want to shave off. Real quick, as an example, let's just assume that I wanted to dump half of my delta, right? I'm plus 102.9. I could just buy one at the money put. So we're at 36.15. If I go and I look at a 36.15, which is about 48 delta, if I buy one of these puts, I am giving up some profit potential on the upside in the exchange for making my T+0 line a little bit smoother on the downside. And that's one way I like to manage my trades, kind of giving myself room for more downside and not having to panic out of the trade. In this trade, I did not make any adjustments to the downside. I was looking at a chart, and initially, right when I took this trade, we were at 39.80. We moved up a little bit. We're still in a pretty strong downtrend, as we can see that 8-day moving average is way below the 21-day moving average. We are now way outside of the expected range that was established when we took the trade. We have RSI at about 29.82, so we are oversold. I don't think that we need to make any adjustments just yet. So we go forward one more day, and now we're at 36.10. We have a down day, but not down much. We're down about 30 points on the S&P. And let's take a look at the P&L. So we go back one day when the market was down 100 points. We had an unrealized gain of $9,932. So we go forward one day, which is another down day, but we didn't move with a lot of speed. So now we have a lot of premium coming out of the short 3250s. And the P&L went from 10,000 to 17,000. Now we're still in a very good spot here, right? We're inside of the short put at 37.60 and the short put at 32.50. We could take a look at a chart. Again, we're sliding down. We're still in a downtrend, but I don't think that we are going to see as much downside going forward. Let's move on to the following day. This is Monday, October 3rd. We have a big update. We're up plus 108 points on the S&P. This position is now showing a gain of about $22,000. Again, we reference back to the chart, and we can see that the price is now moving up towards the declining 8 EMA. We have RSI has moved up from about 30 to 39. We have MACDs are still in a sell signal way below the zero line, but they're starting to kind of flatten out, and that tells me that odds of the price moving to the upside is relatively high versus odds of price continuing to go down. So now here, I went from being long delta on the way down. With this move up, I am now starting to accumulate short delta, and this is a function of short gamma. So now I have to think to myself, what am I going to do if the price starts to move outside of the trap, right? I have an unrealized gain. I obviously don't want to ride this trade up and down and potentially give up some of the profit that is currently in this trade. So now I have to think, what am I going to do if the price continues to move higher? So one thing I can do to lock in some of that profit is to close out a part of my 3,800, 3,760 put debit spread. I went ahead and I closed 4 of the 10 put spreads. I collected $25.40. I originally paid $8.55. I sold to close 4 of the 10 put debit spreads for $25.40. Again, looking back at the chart, we're now at the 8-day exponential moving average. And I think that we are going to see a little bit more upside in the coming days. So we can go forward one more day. And now we are up another 103 points on the S&P. This is Tuesday, October 4th, about 3 p.m. Eastern. And this is what my trade looks like. Once again, I'm starting to accumulate more negative delta on the way up. My goal is now to at least keep some of this unrealized gain in the event that price is going to move outside of my bear trap. And now we are approaching the 21 EMA. And I think that if we can take out this moving average, we have a potential to rally up to the 50-day moving average, which is at around 4,000. Looking back at my risk graph, if we run up to about 4,000, this trade will show an unrealized gain of about 14,000. We are at about 20,000. So to lock in some of that profit, what I did was I closed out 3 of the 6 put debit spreads. And I did that collecting $17.55. My delta now is back to flat. If we see more downside, I'm fine with it. We're going to move back towards the bear trap. If we move up to the upside and we run to about 4,000, no big deal. I will have locked in about $18,000. So on October 6th, the price is now trading at 37.65. We can look at a chart. We ran up to the 21 EMA and we can't seem to get through to it, right? The price is consolidating, but we're kind of 1 foot in and 1 foot out of my put debit spread. What I did was I closed 1 of the 3 remaining put debit spreads. And this is what this adjustment looks like. I sold 1 of the 3 put debit spreads. I collected $20.10. Now my delta is slightly positive. I really don't care at this point which way the market moves. It could go up. I'm okay with it. I will have locked in about $20,000. If it pulls back, I have more room for more potential gains here. Now we can go forward to, this is October 11th. So now on October 11th, the price is at 35.89, right? On October 6th, we were trading somewhere around 37.68. Now we're back inside the trap. We're at 35.89 looking at the price. So we did not pass through the 21 EMA. We're back down to retest the lows at around 3,600. What I did was I looked at the value of my short out of the money puts. There's 3 days left. Now those puts were sold originally for $5.70. They are currently trading for 70 cents. What I did was I went ahead and I closed 10 of the 20 short out of the money puts. This adjustment did several things. Number one, it has removed my directional exposure. It cut my delta to almost flat. This is what the trade looked like before making the adjustment, right? So I'm still holding 20 short puts. I have plus 15 delta, which is not a lot. But we're well inside the trap with 3 days to go. I decided to go ahead and take off half of my short out of the money puts to not only flatten out my delta completely, but also to remove some of the buying power that was tied up in this trade. Now we can go forward to the 12th. We are trading at 35.80. We can reference back to the chart. We're holding a recent low that was set on September 30th. So now what I did was, with 2 days to go, I decided to go ahead and close out the remaining 10 naked puts. They were trading for 70 cents day before. Now they're at 80 cents. Not a big deal. I went ahead, closed out the naked puts, and now we are here. So now we have 2 days to go. I'm just left with two 3,800, 37.60 put debit spreads that I paid $8.55. And we can see that their value right now is at $37.50. Now with the 2 days to go, I can just let it run out, meaning at expiration, if I let this go to expiration, these puts, longs, and shorts are going to cash settle. This is a 40-point wide spread, which means that at expiration, this spread is going to be worth 40 points or $4,000 each. I decided to go ahead and close out the remaining put spreads just to get out of this trade and not risk price moving outside of my put debit spread. At expiration, 3,800 or higher, I go from being up about 26,000 to being up about 19,000. So there's a $7,000 worth of risk in this trade with 1 day to go. And I model this trade to close. I paid $8.55. It is currently trading for $36.85. Holding to expiration, the spread could potentially be worth $40. So I'm giving up about $3.15. I decided to go ahead and close it out. And this trade netted me just about $26,419. I hope this was clear, and I hope that this kind of gives you an idea about this trade. 112 Bear Trap, 113, call it whatever you want. If you have any questions, feel free to post below. Also, if you enjoy this content, subscribe to the channel, share this video, and we'll see you in the next one.